Hi everybody, my name is Philippa Sturt and I'm currently a corporate partner at a law firm called Joelson. I will be there for the rest of this month, and then I'm moving to a new firm called Clark, who are based in Holborn. So I'm just going to talk for about half an hour on raising money for your business, because a lot of what I do is working with startups and early stage businesses when they're looking to raise money. So I'm just going to run through a few of the basics. So first of all, where does funding come from is the first big question. Now, a lot of businesses, a lot of WIBN businesses, for example, won't need to raise money. You'll have a lifestyle business that you're perfectly happy with the way it is. But you may want to grow your business. And quite often when you're growing an early stage business, you need some funding from outside to grow that. So where does it come from? Well, one source of funding that lots of people come up with is banks. But there is a problem with banks. It's fine if I'm getting a mortgage for my house, for example, but early stage businesses find it much harder to raise money from banks. And that's because banks are very risk averse. They don't want to lend out money unless they know they're going to get it back. And so they look for lots of ways to protect themselves in the event that the company that they're lending to won't be able to pay that money back. So they'll want to take security over the assets of the business. And they might even ask you as the founder of a business to give a guarantee, a personal guarantee that the money is going to get paid back. And that means if the company doesn't pay it back, you have to. So not a lot of people want to get into a position where they're agreeing to a bank to pay back hundreds of thousands of pounds potentially with an early stage business. And also, most startups don't have a lot of assets. So there's not a lot for the company to take security over. So it's quite hard to persuade a bank to lend you money. So where else do you go for money? Grants are quite useful. So depending on the type of business you've got, there may be government grants or other sort of charitable grants out there that you can get to help you grow your business. But without that, where else? Well, one of the ways, which I'm not going to talk about today, but I'm happy to chat to anybody about anytime, is private equity or venture capital, as it's often called. And that's where an institutional investor puts some money into an early stage business. Now, the problem comes that a lot of institutional investors are a little bit too heavy-handed for really early stage businesses. They want to get involved early stage, but they almost want to take over your business and run it for you. And for most founders, that's not a very comfortable place to be. So where else? There are two things that I'm going to talk about today. Angel investors, those are, it sounds nice, but they're just individuals with a bit of cash who want to put money into your business. And crowdfunders. So that a crowdfunder is normally a platform, an online platform that allows you to go on that platform and basically advertise your business to raise money with lots and lots of tiny shareholders who put in sort of between £10 and a few £1,000s into your business. So the two I'm going to talk about today are angel investors and crowdfunders. So starting with angel investors, where does it come from? Who does it come from? And how do you do it? Well, where does it come from? This is an example, it's quite an old example now because I've been using it for a while, of me Googling Angel Investment UK. And literally there were thousands and thousands of pages of potential investors listed just on Google. So good starting place, Google it and you will find lots. But really the point of angel investors, which I'll talk about more in a minute, is the fact that they can potentially give you more than just money. So a really good idea is to look for somebody that is in your industry, in your sector, that might want to invest in your business, that can do other things as well. And really leverage your networks. See if you know somebody who knows somebody who knows that person. And that is potentially the way to get investment. So who? This is the only bit of law that I'm going to talk about at all. But it's quite an important bit of law, the Financial Services and Markets Act 2000. Now, this piece of legislation made it a criminal offence. Yes, criminal offence. This is where people start to get panicky. Punishable by 2 years in prison and a fine to financially promote to members of the public if you're not an authorised person. And what is financial promotion? Financial promotion is doing exactly what you, as a founder of a business, are likely to do, which is to go to people and say, I've got this great idea, I've got this business, you give me some money and I will give you shares in my business. That's potentially criminally actionable, punishable by a prison sentence. That being said, and that's where people start to get really panicky because they think, oh my God, I literally just asked somebody for money. Am I going to prison? I have never known anybody to be criminally prosecuted for getting financial promotions wrong. But the problem with it is if you do this wrong, if you've taken money from somebody that you've wrongly financially promoted to, any contract that you enter into off the back of that illegal financial promotion is potentially void at law. So if you've asked somebody for money who you shouldn't have done, they've given you money, things aren't going too well, and they ask for their money back, you don't really have a leg to stand on to say no. You've kind of got to give them their money back. So you need to think about this quite carefully when you're asking people for money. Now, there's something called the Financial Services and Markets Act 2000 Financial Promotion Order 2005. And this is the thing that sets out exemptions to that original prohibition that says you can't ask people for money. And they are effectively a list of exempt persons that you can speak to and ask if they would like to invest. And the main ones that people use when they're founders and they're starting their business are high net worth individuals and sophisticated investors. And a high net worth, both bars are quite low. So a high net worth individual is somebody who has earns over £100,000 a year, which before lockdown was quite a few people, or somebody who has over £250,000 worth of net assets, not in their own home. So the kind of well-heeled people that you're likely to be asking for money anyway, because you know they've got it, those are probably going to be high net worth individuals. And a sophisticated investor, again, it's a low bar. It's somebody who has invested in at least one private company in the last 2 years. So again, the kind of people you're probably going to approach as angel investors probably fall into those categories. And there are some other categories that you can ask as well. So for example, somebody who's a director of a company that turns over £1 million a year, somebody that has been a member of an angel syndicate for at least 6 months, any professional in the fundraising sphere. So there are quite a few people you can speak to, but you just need to make sure you do it right. And so the question I'm normally asked after that is, how do I protect myself? How do I make sure I'm not falling foul of this legislation? Well, there are two things you can do. One, if you've got a pitch deck or an IM or a business plan, anything that you're punting out to people to say, here is my idea, give me some money. It's a really good idea to have a disclaimer on that. So you put a disclaimer on the front that pushes the risk onto the investor. So it says, do not read this, Mr. Investor, unless you're a high net worth individual or a sophisticated investor and therefore allowed to read it. So you're making it their problem, not yours. Likewise, you can, if somebody is really keen to invest and is sounding like they want to, you can ask them to self-certify themselves. So that's a piece of paper that they sign that says, I hereby certify I'm a high net worth individual or I'm a sophisticated investor. And by doing that, you're pushing the risk onto them as well, because if in the future they turn up and say, you should not have made that financial promotion to me, you can say, but you signed this certificate to say that you were a high net worth individual and therefore I could financially promote to you. So you're giving yourself some defense if they come back to you in the future. And all I would say there is I have seen it happen where things haven't gone too well with an investment and investors have started asking for their money back on the basis that financial promotions legislation was not complied with. So you need to bear that in mind. Another thing to think about with angel investors is you are asking individuals to invest in your business, but they bring with them potentially so much more than just the money. So they bring hopefully value add. So they might be an individual in the sector that you are operating in, who has loads of contacts, knows loads of people, knows how to do a specific thing really, really well. So for example, I have a client that before lockdown was a restaurant fast food business. They initially got in an angel investor who really, really knew about leases and buying premises for shops, because that's what they were going to do for the first year or so of their business, was start to buy up lots and lots of leases. So you can find somebody who can give you expert advice in your area, but also probably the best thing about angel investors is they hopefully have a little black book of other people who are all quite well heeled, all have money, who also might want to invest in your business. So you hopefully they introduce you to other people and the ball rolls in that way. And also hopefully you'd be looking at them to see if they can follow on. So to see how deep their pockets are, get an idea of whether they can just invest £50,000 in you to start you off, or whether they're going to be able to do the next round for a couple of 100,000 or the round after that for £1 million. So it's worth thinking about their future value to you. Now, the one thing I would say here is think about the person as well as the money that they're giving you. It's really easy to just be so desperate to raise money for your business that you take whatever somebody offers. But the number of times, I can't tell you the number of times I've seen it, where people take money from an investor who is a little bit difficult or a little bit annoying, and within a year they're ringing me up saying, how do we get rid of this person, because they're driving us bonkers. They're insisting on board meetings all the time because I've made them a non-exec director on my board. They're ringing me up and asking me why I'm doing X, Y, and Z. They're sticking their noses into the way the business is run, and I just want to get on with my business. So you have to know that that person is somebody that you can spend a long time with. That person is somebody who you think will be useful for your business, but character-wise, that you guys get on, because as soon as you fall out, there's potential serious problems. So just think about that when you're bringing in angel investors. Now, the other thing that you've probably heard about with angel investment, which I don't have time to talk about today, but I'm always delighted to talk about it if anybody wants to, is SEIS and EIS, the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme. And these are basically tax breaks created by government, which encourage individuals to invest in startups. Startups are risky, you often lose your money. So what these do, and they're two different scales of the same thing, what they do is basically give the investor money off their income tax in the year they invest, if they invest in a startup. And also, if they take that tax break and hold the shares for 3 years, they're also capital gains exempt on the way out. So that's why investors love it, because A, they get money off their income tax, but more importantly, they all think they're investing in unicorns, and at 3 years' time, they're going to sell their shares for kind of 20 times what they invested, and they're not going to have to pay a penny of capital gains tax on that gain. So think about SEIS and EIS. They're quite complicated. You need to abide by the rules, but that's because they're so attractive to investors. And finally, I was just going to say something very quickly on valuation of your business. So one of the questions I get asked, possibly more than any other, is how do I value my business? How much of my business will I need to give an investor when they invest? So normal investment, the investor puts cash into your business in exchange for shares. And people get very worried about the percentage of their business that they're effectively going to have to give to that investor. And the answer is, or my answer to this is, I can't really tell you, because the way in which you value startups is so different depending on the startup and depending on what's going on with it. Things that will increase your valuation are things like a great management team. If you've got people in your management team who've done this kind of thing before, who've had a successful startup that they've maybe sold in the past, all of those are going to make it look attractive to investors and therefore allow you to command a higher valuation. Maybe if you've got a grandee from your industry on your board as a non-exec director, again, it adds weight to your proposition, makes you look more credible to investors. Obviously, having an MVP, so having a product which is out there in the market, is going to increase your value to investors because they can see it working, and any customers that you've got, any traction in the marketplace is really going to add to that valuation again, as is intellectual property that company owns. So the idea, the concept, the coding, if it's an app, the brand, if it's the brand name, if it's a brand, all of that is going to add to the value. But how much would that value be? It's impossible to tell you. All I can say is it's a bit like if I was selling my flat. If I put this flat that I'm in right now on the market tomorrow, and I immediately the next day got an offer for the asking price from somebody, I'd know that I'd valued my flat too low. Okay, so no one is going to, or at least in my experience, investors do not say, no, I don't want to invest in your business because they think your valuation is too high. If they really like your idea and they really like the business, they'll say, I love it, think it's a brilliant idea, I'd love to invest, but I think your valuation is a bit toppy. Let's have a conversation about, you know, what percentage of the share capital I'll get when I come in. Okay, so I would suggest that it's almost better to have that argument with investors and be able to justify the value that you're putting on your business than to put a value on that people just sort of say, oh yeah, that seems fine. Because if you don't value your business, no one else is going to. And that being said, what do I see valuations at for startups? Mostly over $1 million. And I think that's just because $1 million sounds like a nice round number. I don't think there's any magic to it. So really think carefully about your valuation when you get to it. I had a client recently who was getting 150,000 from a VC, and the VC's offer was quite nice, but they were valuing her business so low that she would literally be left with about 50% of the business when she first started, and that's doing just the first seed round of investment. And there, if you look at it in the future and as you go along, you're probably going to do more investment in the future. You might have another couple of rounds. You're going to get diluted as a shareholder all the way along. If you end up, and it's really a matter for yourself, but if you end up as a founder with, say, 15% of the business, are you really going to be comfortable with that? Is it enough to incentivize you to grow that business and want to sell it in the future, which is what investors are looking for you to do? And if it isn't, then you're probably needing to argue up the valuation, try and keep a bit more of the business. Lots of people get hung up on 50% and 75% because those are the percentages over which you can pass a special resolution and an ordinary resolution, which are shareholder resolutions for a company under company law. I don't think they're that important other than psychologically, actually, because there are other ways to protect yourself. If you fall below 75%, not the end of the world. If you fall below 50%, it's not the end of the world. You've just got to manage things a little bit differently. So bear that in mind. So that was a very quick canter through angel investment and how to deal with individuals when you're looking for money in. And now for the last, hopefully, about quarter of an hour or so, I'm just going to talk about, yes, exactly quarter of an hour. I'm going to talk about crowdfunding. In case you don't know what crowdfunding is, I'm going to talk about how to crowdfund and why you would crowdfund. And this should be prefaced by the fact that anybody that knows me knows I'm not a huge fan of crowdfunding, but I'm going to try and be impartial in this discussion. So how does crowdfunding happen? There are kind of 3 different ways that it happens. Something called donation, and that's things like Kickstarter, where you go onto the website and you offer, I don't know, your product cheap or a free coffees or a t-shirt or whatever it is, different levels of rewards depending on how much people invest in your business. Now, I wouldn't get involved in that as a lawyer. Nobody does. It's not a regulated activity. It's just a kind of quid pro quo thing. And sometimes it can work out very well, but it tends to be for small amounts of money. The 2 main ways to crowdfund are equity, i.e. offering shares to investors on a crowdfunding platform, or debt, taking money from investors as a loan on a crowdfunding platform. Now, debt crowdfunding has had a really bad press recently. There have been some quite high profile investments or lending on a crowdfunding platform where the crowdfunders, the company's gone under, the crowdfunder hasn't had their money back. So it tends to mostly be equity at the moment because debt's got a bit of a PR problem. But the 2 main crowdfunding equity platforms that you find, you've probably heard of, are Crowdcube and Seedrs. Now there's a rumor, well, more than a rumor, I had an email about it from Crowdcube and Seedrs saying that they're planning to merge sometime this year, next year, which will be a little bit awkward because at the moment they're the 2 players in the marketplace and you can play them off against each other. Once they merge, I'm not sure how that's going to work out. And I would think that the Competition and Markets Authority will have something to say about that before it happens. But as I said right at the beginning of this talk, crowdfunding is basically you go onto a platform, you get lots of little tiny investors. So you might have 500, 600 investors all putting in little bits of money so that you can raise a reasonable amount of money on the platform. And I'm going to talk about the pros and cons of crowdfunding now. So the first pro and con potentially is cheap advertising versus expensive capital. Or another way of putting this is raising your profile versus raising money. Okay, so what crowdfund platforms tend to be quite quiet about, and what not everybody knows, is it's not as easy as you might think to crowdfund. So a lot of people who are finding it hard to raise money think, oh, I'll just go and do a crowdfunding round, it'll be easy. And they think that you rock up to a crowdfunder platform, ask to go on, get put on it and raise the money. It's not as simple as that. Crowdfunding platforms, Crowdcube and Seedrs and the others, will want you to have raised between 50 and the highest I saw was 89% of that raise yourself before you go on the platform. And so you still have to do the work of finding investors and finding at least normally 50% of that investment amount before you're allowed to go on the platform and offer that investment to the crowdfunders on the platform. Now, Crowdcube and Seedrs say that the reason they do that, and I was on a panel with one of them, can't remember which one, and I actually asked them directly. They say the reason that they do that is because they want to know that you are committed to raising money via a crowd platform. And so they want to see you do a bit of work. I would suggest there's another reason for that, which is they want to slightly spin things for the crowdfunders on their platform. Because if you go on day one, you go live on the platform with your business looking for investment, and on day two, you're already 50%, half of the way towards your target. If I'm a crowdfunder on that platform, I'm going to look at it and think, oh, that's good. You know, people are obviously really enthusiastic about that business. They're already halfway to their target. And maybe then I'll invest where I wouldn't have done before. So I think it's a way to kind of create a bit of excitement around a fundraise on a crowd platform. Now, if you're a B2C business, crowdfunding can be really useful because it basically raises the profile of your business and hopefully gets you lots of people hearing about and looking at your business. And for that, it can be quite cheap because advertising is quite expensive. But in terms of raising money itself, raising capital, it can be quite expensive. And that's because the crowdfunding platform that provides the service wants you to pay normally an upfront fee and also a percentage of what you raise. So what you raise is going to be more expensive because you're going to normally have to pay between 6 and 7% of what you raise to the crowdfunding platform. But all I would say about that is there is always a deal to be done, and you can get, depending on how attractive your business is to the platform and how much they want you to raise money on their platform, you can get them to reduce their fees. So make sure that you remember that everything is negotiable. The second pro and con is invested brand ambassadors versus disinterested investors. So as I said in the first one, you can get these people who are kind of invested metaphorically, but also actually in your business, because they go around telling people that they put £10 in your business and that they own a bit of you. And that can be a great way for you to get sort of advertising and get traction in your business. And I used to have an assistant who did a lot of crowdfunding, and she was always telling me what she'd invested in and being quite excited about it. So if you think you've got hundreds of those people, there's potential there to raise a bit of traction in the marketplace. The other side, however, is that you tend to have a lot of tiny shareholders that don't really care about anything you tell them. So, and this is going to lead on to my next point, but there are things that you have to do as a company to move the company along. So if you're raising money, you may well need to do a written resolution to get authority to allot shares and to waive preemption rights. And for example, waiving preemption rights needs 75%, over 75% of the votes in shares to agree to that. Now, if you've got a load of investors who only put 10 quid into the business, they get a written resolution through the post or by email to you, asking them to sign it. They will just throw it in the bin or just not read it. And so let's say you've put 20% of your share capital on a crowdfunding platform, you're going to have to work the other 80% of your shareholders really hard to pass that 75% mark, because 20% of your shareholding is probably not going to respond to anything you send them. Okay, which leads on to the next point, which is shareholder admin. Now, as I say, that can be really annoying when you're trying to do another share funding round, for example, and you need to waive preemption rights, and a load of your investors just ignore you. You have to work so much harder to pass the resolutions that you need to pass from your other shareholders. And likewise on a sale, there is something, most companies have something called a drag along, which means that a majority of shareholders can force the minority of shareholders to sell if the majority wants to sell the company. But most purchasers of companies want you to actually find every individual shareholder and get them to sign a stock transfer form transferring their shares to the buyer. Now, if you've got 400 shareholders and several of them have changed their email addresses and changed their actual addresses and you can't get hold of them, it makes selling your company much, much harder. There are ways around it, but trust me when I say it's really tricky. There's something called the squeeze out. And at Joelson, we did one of the first sales of a crowdfunded platform, a crowdfunded business. We couldn't find all the shareholders in the business because some of them had changed their details. So we had to go through this thing called a squeeze out, which is a statutory process that you go through where you get 90% of shareholders to agree to a sale. And we are still holding money in our client bank account for shareholders that we couldn't identify. So with crowdfunded businesses that happened a while ago, that becomes a problem because a lot of them have hundreds, if not thousands, of shareholders on their cap table. Now, the flip side of this is something called the nominee structure, the nominee shareholder, which is something that both Crowdcube and Seedrs now offer, which is where they have a nominee company that has the legal ownership of the shares, and beneficial ownership is held by all the individual crowdfunders. And what that means is you only, as a founder, as the owner of a business, you only ever deal with one shareholder, the nominee, who you ask to sign things, who you speak to, who you tell what's happening. And so that makes life a lot easier now. But in the early days of crowdfunding, that wasn't available. In fact, I actually wrote the first Crowdcube trust document for a nominee because I was on the other side of the very first crowdfund where they brought in a nominee structure. So it's only happened in the last few years. This is another con actually, which is timing. It takes a long time to do a crowdfunding round. You have to get your company ready to go live on the platform. You then go live for a month or 2 months where people are bidding to say that they would like to invest. And then you have a cooling off period at the end after you stop being live, where the crowdfunder will offer the crowdfunding individuals the chance to change their minds and not invest after all. And so if you think that you're going to do a crowdfund quickly, think again, because it takes 2 to 3 months to do it. And the final pro and con is reputation versus shareholder activism. So reputationally, if you do a successful crowdfund, reputationally, it can be brilliant. Think of Brewdog, for example. You get it makes your brand sound even better. People know about it. Success breeds success. But on the flip side of that, if you don't reach your target, it can look really bad, because if you don't reach your target, nobody invests and it's all over. And most of these crowdfunding platforms have sort of message boards and things like that. If you have one shareholder who is a bit grouchy or a bit annoyed with you, they can make your life an absolute misery. And I know, because I've seen it happen, by posting sort of slightly defamatory things about you, rude things, complaining about things, emailing you to ask you questions the whole time. So, just bear that in mind if you're thinking of crowdfunding. So I suppose in summation about crowdfunding, what I would say is think about why you're doing it, because at the moment, if you're doing it just to raise money, certainly at the moment, I would say it's probably a bad idea. I've seen a few companies crowdfund during lockdown. They aren't managing to raise a lot of money. I don't think people right now are that enthusiastic about investing in startups via crowdfunding. If you're doing it because you want to raise the profile of your business and raise a little bit of money as well, then it might be just the thing you want to do. I have a client with a B2B business who literally went on to, I can't remember which one it was Crowdcube or Cedars, just to raise the profile of their business, and they weren't really anticipating that they would raise any money at all. And actually they raised a little bit of money, but they also raised their profile. So I think you just have to think really carefully about why you're doing it. So that's it from me, just a very short snapshot of angel investment and crowdfunding. If you want to ask me more questions, my mobile number is on the screen right now, and I really genuinely will talk to anybody, as I'm sure anybody that knows me will attest. So that's it. Thanks for listening.